Market cycles ultimately drive everything in the investment world. And so what happens is on the upswing of a market cycle, people are feeling a sense of accomplishment, of euphoria. They start to extrapolate the recent past with what's going to happen in the future. And so they tend to forget that what goes up must come down. When greed and buying turns to fear and selling, that drives the markets lower. They've moved from being primarily dovish, providing accommodative monetary policy, to now tightening monetary policy. I think part of why they're doing this is they're trying to give themselves room to lower rates prior to the next recession. People will get to a place where they expect the Fed to step in. And so it's kind of like an elevator where you have, we've got a safety. So if it drops more than 2 floors, the safety will kick in. And then all of a sudden the safety doesn't kick in and it just plummets. My concern is that people think, the Fed will just lower rates, but it's not going to matter the next time. That's my fear. And that's a real fear because the confidence is lost. We are convinced that we are extremely late in this particular cycle. That's partly driven by the fact that this is the second longest recovery in U.S. history. The only time that we've had a longer recovery between recessions is in the 1990s. And that was on the back of the internet revolution, the personal computer revolution. And we had a huge boom in this economy that was really allowing us to extend that period of time between recessions. In this case, in this latest recovery after the great financial crisis, this has really been driven more by low interest rates, cheap money, cheap debt. And so our concern is that we're seeing overvaluation that has eclipsed 2006 and 2007. We've seen that in the real estate market. We've seen it in the stock market, in the bond market, in just about every financial instrument. We've seen people who are willing to pay a premium because they have already forgotten the downturn of 2008, 2009. Our federal debt levels are higher by about double where we were in 2006 and 2007. Our state levels are about double where they were in 2006 and 2007. And personal consumption and personal indebtedness has gotten to a place where the savings rate has been driven lower and people are really indebted to the hilt. And they're at a place where they have very little room to afford their ongoing expenses and living expenses. We think it's time to be defensive and start to make all investment decisions based on what will this investment do in light of the next recession.